let's get moving and talking about trend patterns and their interpretations. Now in tonight's class, I'm going to use the term security, but I might say the euro or Facebook or Bitcoin, but I'm not referring to any specific asset. It just gets very boring saying the same thing over and over. We're talking about all publicly traded financial instruments. Similarly, I also intermix the terms investing and trading. Since we're here as part of ETX, we are traders, and we know the difference between investing and trading. But again, it gets very boring just saying trading, 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 trading. Now, technical analysis refers to the study of the financial markets based on price movement. It uses the assumption that price of an asset reflects all the information about that asset, including market sentiment as well as its perceived value. Charting refers to technical analysis that is performed through careful inspection of price data for identification of well-known patterns that emerge in prices. For example, head and shoulders, channels, triangles, and wedges. Now, I've taken the term technical analysis and I call it chart analysis, because basically anything and everything you do on a chart is part of technical analysis, whether you're just looking at price, whether you're reading a candlestick, whether you're putting a simple moving average on your chart, or whether you're putting a complex strategy. It's all technical analysis or chart analysis. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system, but rather provide an indication of the future trend of an asset as price breaks key psychological barriers. Now, there are numerous types of patterns, all named according to the shapes on the price graph that form between the support and resistance lines. So let me pop you over to what I call my market structure chart. There we go. Okay, as soon as it pops up on your screen, I call this market structure. As you can see in this asset, we can track almost all the major patterns. We start off on the right, we see head and shoulders pattern. We see a cup and a handle. We see an expanding wedge. We see an inverted cup and handle. We see an inverted head and shoulders. Then we see bear pennants, bear flags, triple tops, descending wedges, ascending wedges, bull pennants, bull flags, double bottoms, and so forth. Now, these patterns are well documented. They appear over and over and over in historical charts. And when these patterns appear, we can understand or predict, or some of the randomness comes out of the markets, because what we can see in these patterns are the psychological impacts of human beings on the market price. And when we see a particular pattern being developed, we can then interpret what's going to happen. And each different pattern that we see developing has very specific rules about it and will help you make trading decisions. I personally only trade from chart patterns. I'm a big triangle trader, okay? And I trade from chart patterns, support and resistance, and volume. I don't use any other technical indicators except when I need something that helps me finalize an iffy thing that's happening in the marketplace. But I firmly believe in dealing exactly with price and price action on charts. And that's what chart patterns do, because they are exactly interpretations of what price is doing on your chart. Now, we can see here, we have a beautiful triangle formation. This is called a symmetrical triangle, okay? And the markets reacted perfectly to this. Again, here we have a textbook descending triangle. When this pattern develops, we can then make decisions. It helps us understand what price is trying to tell us. So the most popular are triangles. Now, a triangle is formed between converging support and resistance lines. A negative sloping resistance line indicates a reducing level of profit taking or more uncertainty about the values of an asset. With a positive sloping line, the price levels are squeezed into a corner. So we have three basic kind of triangles. Symmetrical, and that is when your horizontal support, your support and resistance lines are on the same angle converging into the apex. We have ascending triangles, and that's when you have a horizontal resistance line with an inclining support line. And then we have the exact opposite, which is a descending triangle. But basically, there are no set rules about what angles they have to be on or whatever. These give them names. I just call them all triangles. I even put wedges in there and I put pennants in there. To me, they're all triangle formations. And these triangles are trying to tell you something. Because once the support and resistance line is broken, pressure that is built up as a result of the uncertainty is released. So all of these have what we call the apex. And price is being forced in to a narrower and narrower trading area as it gets closer and closer to that apex. Now, there are some bias or characteristics of certain triangles and certain patterns that might help you. Some people say they have a characteristic and they are helping predict a continuation or a reversal. I personally say it's a bunch of hogwash. All we know is that price is moving into this apex and it needs to break out. And it's either going to break out upward or downward. If you forget the bias and the character and throw that all in the trash can and just watch your chart patterns, you can make some very smart decisions about the markets. So we have ascending triangles, descending triangles, and symmetrical triangles. So you can see here, once you get from this beautiful little chart to real life charts, it's not so clean cut. The lines aren't so perfect, but they're still making triangle formations. They're still moving into an apex. Now, there's certain rules that apply not just to triangles, but to almost all chart patterns. We can use these to predict when the price breaks out of the pattern, how much momentum it will have, and where we can set our targets. And our target or our limit on the order would be the equal distance of the width of the triangle. Now, some people say 50%, some people say 150%. The rule of thumb is the momentum will be equal to the width of the triangle. So we don't know if this is going to go up or go down, but when it does break out, the momentum should carry it that distance. Okay. After triangles, actually, before we move away from triangles, I got a little presentation prepped up for you. Let's take a look at that, and then we'll go back and look at rectangles and wedges and all that other stuff.
The symmetrical triangle pattern is formed by two intersecting trend lines of similar slope. These two lines are converging at a point called apex. The coiling of price that happens inside the triangle will eventually result in a breakout. The breakout can occur in any direction and the move is often as big as the base of the triangle. The ascending triangle pattern is easily recognized by a rising trend line intersecting with a flat resistance line. It is often regarded by traders as a bullish pattern because the price keeps bouncing off a resistance line that may eventually be broken. That descending triangle pattern is formed by a descending trend line intersecting with a flat support level. The repeated attempts of the sellers to push the price down can result in a breakdown through the support line. In all cases, The stop loss can be placed beyond the opposite trend line. The stop loss distance can be at least as big as the distance between the trend lines, measured at the moment of the breakout. A good place to place the take profit level is considered to be as far from the breakout point as the triangle base is wide. Choosing the take profit distance a little smaller than the base width, if the risk-reward ratio allows it, can increase the chances of price reaching it. These chart patterns have no predictive properties, but they may give hints about the forces involved in the market.
Now, once we move away from triangles, we go to channels and rectangles. Okay. We could call a rectangle a double top, a triple top. To be honest with you, in our type of trading, in fast moving, they occur so often that you actually never see them. Okay. So a channel is formed between parallel support and resistance lines. This pattern usually indicates a relatively strong trend up or down, with the price staying within the lines until the breakout. A breakout from a channel indicates either a reversal in a trend or a change in the slope of the current trend. So similar to a channel, a rectangle is a pattern formed between horizontal support and resistance lines. Rectangles and channels are sometimes referred to as flags and pennants, depending on the slope of the initial trend and the slope of the breakout. A flag would be defined as a bullish continuation channel down or a bearish continuation channel up. So let's go back to my market structure chart again. And I personally do not separate pennants at all, because to me a pennant is simply a triangle. It's almost identical to a symmetrical triangle. A flag is simply a channel. But we call these sometimes pennants and flags or channels of rectangles. From there, we also go to wedges. And the only difference between a wedge and a triangle is that the two angles, the support and resistance angles of the triangle, of the wedge, are not equal distance or equal angle inclines. See, on a on a triangle, a symmetrical triangle, you have two support and resistance that are moving in the same inclines, up and down. A wedge has two different inclines. So even though they'll eventually get together and form an apex, one is moving on one incline, one is moving on the other incline. Symmetrical triangle, a descending triangle, and an ascending triangle always have a horizontal support or resistance line. So a pennant simply is a symmetrical triangle. So wedges are similar to triangles, and these patterns are formed between converging support and resistance lines. However, where the support and resistance lines in a triangle have one positive and one negative slope, the support and resistance lines of a wedge would both have either a positive or a negative slope. Wedges with positive slopes are called rising wedges, and wedges with declining slopes are called falling wedges. The most common wedges are found as a breakout in the opposite direction of the wedge. That is, bearish breakouts in a rising wedge and bullish breakouts in a falling wedge. But again, wedges, triangles, rectangles, pennants, flags, do not, if you let yourself get stuck in the bias, okay, like we just had here, that is bearish breakouts in a rising wedge and bullish breakouts in a falling wedge. You'll get yourself stuck looking for a particular trade. There is no correlation between the pattern, the price, and the breakout direction. And that's why you can't just make a trade. You have to wait for a breakout and a confirmation, because there is no guarantee which direction they will go. So don't get yourself stuck in the bearish and the bearish and bullish characteristics. Then we come to one of the most famous patterns, and this is called a head and shoulders pattern. And the reason why is it looks just like a head and shoulders of a human being. We have the left shoulder, the head, the right shoulder, and this green line is called the neckline. Okay. We also have an inverted head and shoulders. Remember, in trading, we have mirror images of everything. Now, a head and shoulders, you read about them often, they take a long time to form. Okay. And you won't even recognize the head and shoulders until it's making the right shoulder over here. And you wouldn't even get ready to trade it until it comes here. So what happens is price is moving up, and in a right side up head and shoulders, it's coming off of an uptrend. Price is moving up, it hits a top, it eases back down, bounces off a hypothetical support line, comes back up, breaks above the previous high to make a new high, and then reverses down and comes down and stops at that same support level. At this point, we have a neckline. Okay. At this point, we have the head, we have the left shoulder. We have no guarantee that a right shoulder will ever form. Price then, because price could go this way, price could go that way. But when price bounces back up and then reverses at the equal distance to the left shoulder, we then have the formation of a head and shoulders pattern. When the right shoulder forms and finishes the formation here, when it breaks that neckline, you can then enter a short trade in the market. The opposite is true of the inverse head and shoulders. But until this happens here and the break of the neckline, you have no idea what it's going to be. Now, there's also all types of interpretations in the market. Some people say that the two shoulders must be equal, exactly equal. Okay. I say they can be a few pips difference. The head, some people say it's got to be at 10%, at 20%, at 25% higher. I say this is a head and shoulders pattern. A head and shoulders is like a human being. Some of us have long necks and high heads. Some of us have short squat heads and short necks. Some of us have tall shoulders. Some of us have rounded shoulders. So ultimately, what you have is a head and two shoulders that are pretty equal, and a neckline with a higher head. Now, that higher head could have been just to here. Because when we come to the reality of really trading in the markets, it's much more difficult than these nice little sketches. Here you see a head and shoulders formation on a candlestick chart, and it's virtually impossible to see. Could you pick it out? Well, there's a lot of traders who trade from these, and they can pick them out. I can see them when somebody's put them on a chart for me, but my eye can't pick them out in the middle of a session. But here we go. Price pushed up, touched this, didn't do anything. It hit a high here, it came back down, hit this bottom line here, came back up, went higher than the previous high, came back down, stayed above that neckline, the neckline, came back up, okay, and formed this ugly right shoulder, but they're equidistant. You have the two bottoms, and at this point, when it broke below here, I would have never ever seen that. Okay, so this becomes the question. Now, all chart patterns have formulas. They're very simple formulas to predict the head or where the target point should be and how far the price should go. Okay. In the head and shoulders, it's the distance between the head and the neckline. And when it breaks out below the right shoulder, it should move an equal distance to whatever that distance was between the head and the neckline. Same thing with an inverse head and shoulders. We also, somewhere in the far reaches of chart patterns, we've incorporated multiple tops and bottoms. Okay, these are double tops and double bottoms. Well, I personally completely ignore double tops and double bottoms because price is moving all over the place. And a double top and double bottom statistically happens so often that the markets and price doesn't say anything. It means price moved up, hit a high, bounced off a support line or resistance line, came back down, was kept held by the support, went up another time, came back down. You find that a zillion times in a day. Okay, double tops and double bottoms are reversal patterns that touch either the support or resistance line twice before reversing their trend. There is no way that you can look at these and predict anything. Okay, as many times as it breaks through and does a reversal, as many times as it just keeps on bouncing through. Double tops, 2 touches is too small. Now again, when we see these, we can measure the distance to get our target points because they're the difference between the high and the low. Okay. Now we go to triple tops and triple bottoms. Now statistically, these get a little bit more reliable because when price is bouncing off its trend support and resistance line all of these times and holding that true, okay, ultimately price is going to break through the support line or the resistance line sooner or later. Triple tops and triple bottoms are reversal patterns that touch either the support or the resistance line 3 times before reversing their trend. This is a stronger indicator of a trend change than a double top or bottom. But again, I don't spend any time looking for these, evaluating these, or anything else because they just happen so often. You know, back in the old days when we didn't have online trading and there wasn't so much activity in the markets and the markets moved slower, they had a lot more value. Today, when we're dealing with everything in small little pips and the market's bouncing all over the place, these happen just so often that you can't really give credence to them. An important measure of the quality of a pattern, though, is the trend that preceded it. When you see a pattern developing, whether it's a triangle, whether it's a wedge, whether it's a double top or double bottom, when it appears within a well-developed trend, that pattern is a lot more reliable. When you have a pattern developing in a weak trend, because price can move up without technically trending. To trend to me is push, ease, push, ease, push, ease, push, ease, push, ease. But you can have push, ease, push, ease, push, where there's nothing really well developed or a good quality. It's just a weak up movement. When you have a very strong, well-developed trend moving, when that pattern develops, it's a lot more reliable. So you should always be looking at the current trend that is taking place. Now, ultimately, what I said before was nobody can predict the breakout, the direction. Okay, you're waiting for price to tell you what it wants to do. Now, there's lots of false breakouts. So a pattern is said to have broken out once it has crossed either the support or resistance line. If the pattern broke out in the same direction as the preceding trend, it's called a continuation pattern. If the breakout is in the opposite direction, it's called a reversal pattern. So for example, a pattern described as a bullish reversal triangle would mean that's a bullish signal. That is, the breakout was through the resistance line upward. Now, all patterns have a formula, and the formula is the same. The width of the pattern can then be applied to the point of breakout to get you your target point. Your stop loss should be placed 10 pips below the most current swing low or the most current swing high, depending on which way it's going, before the breakout. And then lastly, our entry point should only be after a confirmed breakout, and it should be, if you're buying, it should be the height of the breakout candle or the buy candle, and you should be waiting for a confirmation, or reverse if it is a sell scenario. So here you see a falling wedge, here you see a rising wedge here. So your stop loss will place above here instead of below here. Now, price resistance occur when an excess level of supply for a particular security accumulates at a price level and creates a glut in that supply, overwhelming demand and impedes an upward movement. Once the markets absorb this surplus supply, price will take up a true meaning. Trading breakouts is best done when the prevailing market condition is either uptrending or range bound, with a price action approaching the upper edge of the range. Once a resistance level has been identified, volume should be monitored very closely. Volume is your final confirmation that you have a true breakout of that pattern. Now, let's go back to my charts. So even though we had expected in this triangle a breakout upward, okay, we didn't get one, and we got a breakout down. Okay. Now, this candle is our breakout candle, but you can't, and this would give you your entry point, but you can't trade that until you have a confirmation. And once you have that confirmation candle close, you would then trade in that direction of the breakout using that low as your entry point. But you need to confirm it. Otherwise, you get stuck with false breakouts all the time. So no matter what pattern you're trading, if you get stuck in the bias and start jumping in and saying, I'm going to sell, and just sell when a candle breaks through it, you're going to lose your shirt. You need to confirm it with several pieces of information. So here again, here's another good example. We have a beautiful symmetrical triangle. Price breaks out, confirmed by the next candle. We would have traded this candle, and we could have traded the width of this angle. Okay. And what do we get? The other thing we want to look at is volume. We should see a jump in volume at that breakout to confirm that break. If you don't have a jump in volume, you don't have a good signal. So you can see all of those pieces of information and watch your chart pattern for it to develop, because there's no rule that has to break out at any given point. It could have gone farther into the apex. You're waiting for that breakout. Okay, you're waiting for the market to tell you what to do. So when the price breaks out of that triangle, then you get ready to do your trade. So let's wrap this up with a little bit of an explanation on overall patterns and candles.
Ascending triangle chart pattern. The ascending triangle is a price pattern made up of two trend lines, a flat upper trend line which acts as a level of resistance, and a lower trend line that joins higher lows in an upward slope. The pattern can indicate that the bulls are gaining control with the higher lows and weakening resistance, leading to a potential breakout to the upside. In this video, now that we know what the ascending triangle looks like, let us look at two ways of trading the pattern. The first way a trader can look to take advantage of the pattern is to wait for price to break out above resistance and then go long. It is always a good idea to wait for the candle to close above the trend line after price breaks out, as this confirms that the bulls are in control. The stop loss can be placed below the upward sloping trend line. To measure the profit objective, measure the height of the back of the triangle and extend this measurement to the upside where price broke out from the trend line. The second way to trade this pattern, which is more conservative, is to wait for the price to break out of the triangle as previously shown, but instead of entering directly after you break out, you wait for price to pull back to the origin of the breakout. In other words, you are looking for broken resistance to become support. The stop loss would be smaller when trading this method, as it would go below the new support level. The profit objective is calculated in exactly the same way as the first method, by measuring the height of the back of the triangle and extending this measurement from the breakout point where price broke the trend line. So far, you have learned that an ascending triangle pattern is a signal of weakening resistance and a potential upwards move. This presents you with a possible buying opportunity.
So remember, trading a breakout is best done with understanding the prevailing market conditions, waiting for the breakout to occur, using a confirmation, checking your volume, and then you might have an opportunity.